All right, let's dive into a question that's quietly shaping the entire future of Europe's economy. We're going to break down a fascinating paper that asks a really simple but totally crucial question. When a central bank tries to fix today's problems, is it accidentally sabotaging tomorrow's breakthroughs? The paper's called Monetary Policy and Innovation in Europe, and trust me, it's a big deal. Just think about it for a second in your own life. When you've got to tighten the belt, what's the first thing on the chopping block? It's a simple question, but it scales up in a pretty dramatic way. For a family, maybe it's that big vacation you were planning. For a company, it could be that cool, ambitious new project. But when we're talking about a whole country, that first thing to go is often the investment in the future itself. We're talking about research and development. This is the very engine that powers tomorrow's big ideas. And it's surprisingly fragile. And that very fragility leads us right into what this paper calls the innovation blind spot. So you've got the European Central Bank, the ECB, right? They're making these enormous decisions that send ripples through the entire continent. We hear about their fight against inflation all the time. But here's the blind spot. What are those decisions actually doing to a country's ability to innovate, to invent the future? And this is where it gets really interesting. You'd think we'd have a clear answer to this, wouldn't you? But nope. The research was frankly a total mess. Even just looking at the US, one major study found that tightening monetary policy totally crushes innovation. But then another one found the complete opposite. So for the incredibly complex and unique economy of the Eurozone, this was just a massive question mark, a huge gap in our understanding. And look, this wasn't just some academic debate. This is a super high-stakes problem. Are the very tools the ECB is using right now to manage the economy accidentally kneecapping Europe's long-term growth? That's the critical question this paper decided to tackle. Now, to get an answer, the researchers first had to make a really important distinction. They had to look at the different tools in the central bank's toolbox, because it turns out not all monetary policy is the same, not by a long shot. Think of it like this, okay? You've got your everyday tool, right? The trusty screwdriver you use for all the standard jobs. And then you've got the power drill, the heavy-duty tool you only break out for a real emergency. The ECB basically operates the same way, with two very different kinds of policy for different situations. First up, we've got the screwdriver. This is conventional policy. It's the one we hear about all the time on the news. It's basically the ECB just tweaking its main interest rate to make borrowing money either more expensive or cheaper. It's their way of gently tapping the brakes or the gas on the economy. And then you have the power drill, unconventional policy. This is the big gun they pull out in a massive crisis, like the 2008 financial meltdown. We're talking about stuff like quantitative easing, which is really just a fancy way of saying the ECB creates new money to buy up assets and pump cash directly into the system. It's a much, much bigger deal. So keeping those two different tools in mind, the researchers dug into over 20 years of data from the Eurozone. And they used this really powerful statistical method to untangle all the cause and effect. So what did they find? Okay, the first major finding is all about that everyday tool, the conventional interest rate hike. And its effect on innovation, well, it's like a slow poison. It doesn't hit you right away, but the damage is deep and it sticks around for a long, long time. And this graph shows it perfectly. When the ECB hikes interest rates, private R&D spending doesn't just fall off a cliff. Oh no, it's way more insidious than that. It starts the slow, agonizing bleed. The paper actually finds that the biggest hit doesn't even come until a full 2 years after the hike. It's a slow squeeze that just chokes the life out of future innovation. But what about the emergency power drill? Unconventional policy, like quantitative easing, it has a completely different signature. It's like a flash flood of cash. It's fast, it's powerful, but it doesn't stick around. And the contrast here is just night and day. When the ECB unleashes this unconventional stimulus, you see this immediate, powerful surge in R&D spending. But just look at that curve. The effect peaks really fast. And then, as the paper points out, it completely evaporates after about 3 years. It's basically a sugar rush for innovation, not a healthy long-term diet. So here's the bottom line. The two main tools in the ECB's toolbox have opposite effects on innovation, and they work on completely different timelines. A conventional rate hike causes a slow, long-lasting decline. An unconventional stimulus, that creates a fast but temporary boost. So this brings us all the way back to the big picture. What does all this actually mean for the real world? How does today's policy really shape tomorrow's future? What this research really shines light on is this fundamental, almost tragic dilemma that policymakers face. The main tool they reach for to fight inflation today, raising interest rates, is a direct, long-lasting blow to the innovation that's supposed to fuel tomorrow's growth. It's a brutal trade-off between today's stability and tomorrow's prosperity. So let's boil it down. What are the key takeaways? First, fighting inflation with interest rate hikes can put a chokehold on innovation for years to come. Second, that emergency stimulus gives a nice short-term R&D boost, but it's not a long-term solution. The big one is that the choice of policy tool matters profoundly. The decisions being made inside the ECB today aren't just about spreadsheets. They are actively shaping the world we are all going to live in tomorrow. And that leaves us with $1 million, or I guess €1 billion question that this research forces all of us to think about. How do we even begin to balance fighting today's fires without selling off the fire department of tomorrow? How do we fix today's problems without mortgaging all of our future breakthroughs?